Hi everybody, this is Damon at ChappelWood Financial. Hope that everybody in the ChappelWood family is doing well. This is a special message that we wanted to send out to you. You know that we're not prone to sending out messages like this and videos just for the heck of it. We always like to make sure there's a good reason. And right now we're seeing extreme levels of volatility in the market. Levels of volatility we've not seen in 2 years since the coronavirus crash of 2020. And so we wanted to take some time to address what's happening and why we have not been sending out a bunch of messages telling you that the sky is falling and that prepare for a meltdown. What's happening right now is painful, it's scary, and I feel like a broken record. I feel like this is exactly what I said 2 years ago, because I did, when the market was crashing down around us. But we told you at that time, don't panic. Just wait. But I don't want to just tell you don't panic. I want to give you the reasons why. And then we're going to end with what you should be focused on depending on where you are in your journey toward retirement, because you're all at different places. So there's a lot that's pressing down on the market right now. But there are some things that are good, and there are other factors that are not necessarily expressing themselves yet that we believe will lead to better days ahead. Number one, consumer spending still remains very strong. 70% of our economic output comes from consumer spending, and of that, 2/3 is in services. Most of the spending that we have been seeing is in goods. That's only about 1/3 of consumer spending. The consumer spending that is continuing to grow and is actually growing stronger is in the services sector. Things like going out to eat, renting a car, things like that. As we see those numbers increase, the spending, that's a good sign for our economy. It's a sign that our economy will continue to grow. It's also a sign that the earnings of the companies that you're invested in right now will continue to grow. Now, if inflation is not brought under control, well, then there is a point at which people will stop spending money. That's what we don't want to happen, and that is why the Federal Reserve is doing what it's doing to try to keep inflation under control. Now, what about inflation? Let's talk about that for just a moment. I want to show you a little chart. So this little graphic right here is one that I recently saw from a presentation from one of our investment partners, City National Rockdale. If you look here, during the 1970s, both sticky and flexible inflation soared. However, so far, only flexible inflation has moved significantly higher. So what are we talking about in terms of flexible versus sticky? Well, sticky is inflation that once it's here, it tends to last. But flexible inflation is that inflation that it can go up, but it is more easily brought down by action from the Federal Reserve, by a reduction of demand, or an increase in supply. So where are we seeing some of the highest inflation? Well, we're seeing it in fuel, gas, and electricity. We're seeing it in car and truck rental, new and used vehicle purchases, food, lodging away from home. This is where we're seeing most of the inflation. However, the good news is that most of that inflation is flexible, meaning that the potential for flexible inflation to move downward in months ahead could relieve pressure on the Federal Reserve to continue raising interest rates. So this is a big reason why you heard Fed Chairman Jerome Powell last week in his comments after they announced the increase in interest rates. He was very specific to say, we raised interest rates 0.5% right now, but we are not considering raising them 0.75% or higher. We don't believe that the current economic environment or the market environment necessitates that. That was an encouraging sign from the Fed, and that's why you saw that day the market went up significantly. Of course, in the few days after that, people panicked, and we've seen a huge sell-off in the market. There's another key aspect, though, to the market that does not get widely reported, but has an absolute huge impact on what happens in the stock market, and that is stock buybacks. One of the biggest customers of stocks out there are the companies that issue those shares. A lot of people say, well, isn't that unlawful? If companies can just go out and buy their shares back, doesn't that manipulate the price of those shares? Well, yeah, it does. But right now you've got one of the biggest customers absent from the market. Why? Because it's earnings reporting season. And during earnings season, companies are prohibited for a period of about 30 to 45 days from buying back their own shares. And so for that period of time, it's a cooling off period while earnings are being reported. They don't want the companies to go in and buy back those shares and be able to manipulate the market during that period of time. When buybacks start up again, I can almost guarantee you're going to see companies buy back a lot of their shares at a lower price so that they can hold on to them and reissue those shares when the market rebounds. The biggest customer of shares of stock for the companies you're invested in, it's not you and me, it's the companies that issue those shares. And right now, they're not on the market. So now you have some reasons why we actually remain optimistic about the long-term prospects for the economy and the market. However, what does this mean for you? If you are not yet retired and you're just a few years away from retirement, and many of you in the ChappelWood family fit that description, well, keep in mind why we're invested the way we're invested. Whenever you first joined us and you filled out your discovery, and we asked a lot of questions about your appetite for risk, and I've been asking a lot of people, has your appetite for risk changed? Are you watching what's happening right now and you want to reduce your level of risk? Most people are saying, no, I don't, because they understand I'm still working, I still have a few years left before retirement, and I still want to get the benefit of growth in the market. We didn't go all to cash 2 years ago when the market crashed because of COVID. We're not doing that right now. Now, if you specifically tell us that that's what you want to do, then we'll talk about that, all right? Because there are pros and cons to that strategy. But the reality is you're not taking money out of your accounts right now. You're still working. And this, painful as it is going to be, we still believe, a relatively short-term situation. We don't see this as a multi-year recessionary market meltdown that's going to take years and years and years to recover from. Now, what if you are in retirement right now, but you're not yet taking money from your accounts? If you're not taking money out of your accounts, then you really haven't lost anything. I mean, technically, you don't lose anything till you liquidate assets and pull money out, right? If you're not actively taking money from your portfolio, but you are retired, remember how your money is structured. We've got short-term buckets of money, medium-term, and long-term buckets of money. That you are never going to use all of your money at the same time at any given point in retirement. Even when you start drawing money from your retirement accounts, you're going to need some of your money now, you're going to need some of it later. So we need to structure it that way. And the money that you need later, that's your more aggressive money, that's the money that's being hurt the most right now. That's where you're seeing most of your losses. But that's also the money you're not going to be using for several years, which leads me right into those of you who are retired and you are actively taking distributions. You're already actively in that phase of near-term conservative money, medium-term moderate money, long-term aggressive money. We're taking your monthly distributions, we're taking your required minimum distributions, not from your aggressive long-term buckets, we're taking it from your short-term conservative buckets, from your bonds, it's your long-term money, your aggressive stocks, and we've got you invested that way. So long as we're staying within that framework of risk, and if your appetite for risk has not changed, don't allow your emotions to overcome your judgment, your logic and reason, and that well-crafted plan that we put together. I'm not telling you don't get frustrated and anxious. Those are normal emotions in times like this. But this message is intended to remind you why you're invested the way you're invested, and that not all of your money is suffering the same. The money that is being impacted the most right now is the money you're not going to be using for quite some time. We don't abandon the total plan. We make little changes here and there. That is how you manage a portfolio for retirement. It is an honor and a privilege to serve you. Thank you for being a member of the ChappelWood family. We're always here to answer your questions, and we're always here to help give you the reasons why we remain optimistic, and we will certainly let you know when that optimism fades. Thanks so much for watching. We'll see you pretty soon.